Good morning, everyone. The theme overnight was the recovery in risk sentiment. So the dollar was little changed against most of the G10 currencies, but the safe havens, the yen and the Swiss franc, eased, while the risk-sensitive Swedish krona and New Zealand dollar rose, as did sterling. The recovery in U.S. stocks helped, but more than that was the recovery in emerging market currencies. Most emerging market currencies were either unchanged or stronger against the dollar, some quite notably so. The Polish zloty, the ruble, the Brazilian real, and the Hungarian florin all gained 1% or more against the dollar. The florin was the big winner, and probably, I think, one of the reasons why sentiment improved. The Hungarian Debt Agency found pretty good demand for its 3-month T-bills yesterday. That was in contrast to the last two auctions where there weren't even enough bidders. It suggests that investors don't necessarily dislike emerging market assets, they just dislike the price. And so once the price adjusted, they're willing to buy. That would change the whole perception of the recent decline, from the beginning of a big rout to just a simple correction, which is a totally different story. It would mean a recovery in the Aussie dollar and the New Zealand dollar, a retracement in the yen and Swiss franc, and probably a stronger dollar too. Now, one day doesn't make a trend, so I'm unwilling to call an end yet to a move that really is based on fundamentals, solid fundamental analysis of some of these countries' economic problems. But it is a notable move. During the European day today, we've got the January service sector purchasing managers indices. In the UK service sector, PMI is expected to be up slightly, not much of a change, but at least in the right direction. It'll be interesting to see whether that has a more lasting impact than yesterday's better-than-expected construction PMI did. If not, then it'll become really clear that sentiment towards sterling has finally turned. Meanwhile, the U.S. ISM non-manufacturing index for January is forecast to show a small rise, but that probably won't be enough to offset the gloom caused by Monday's plunge in the manufacturing ISM. Now, the focus of the day is going to be the U.S. ADP employment report for January. It's expected to show a growth of payrolls of 190,000, down a little bit from 238,000 in December, but still pretty high. Of course, remember that the December figure had no connection at all with the surprisingly low non-farm payrolls for the month, which were up only 74,000. But people will still watch the figure as, even though it's no good, it's still the best indicator we have for Friday's number. For technical analysis and more trading ideas, please see the full comment on our website, IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.